By the time you reach 65, the government is going to be your biggest beneficiary, and you haven't even invited them to the party. We have been sold the ultimate financial sedative, the 401k. For 40 years, the narrative has been identical. Your HR department, your parents, and every mainstream talking head tell you to pay yourself first, defer your taxes, and watch the compound interest turn you into a millionaire. It sounds like a dream. But in 2026, the math reveals it is actually a high-stakes hostage situation. The 401k is not a savings account. It is a deferred tax liability where the government owns a massive undecided percentage of your life's work. They aren't letting you save money. They're letting you manage their future tax revenue. Today, I'm going to prove to you that the standard advice of maximizing your 401k is mathematically dangerous. I'm going to show you why your million-dollar nest egg is actually a $600,000 mirage, and how the system has engineered a tax bomb designed to detonate exactly when you are most vulnerable. You've been told you're building a fortune. I'm going to prove you're building a debt. The reason you fell for this is rooted in a psychological phenomenon known as present bias, combined with hyperbolic discounting. The system makes it incredibly easy to say yes today by offering a tiny immediate hit of dopamine in the form of a tax deduction. You feel like you're winning because you see a slightly larger paycheck today. But this is a psychological sleight of hand. The government is essentially offering you a loan today, the tax you didn't pay, and in exchange, they get an equity stake in your entire future. You fall for it because of loss aversion. You hate the idea of losing 20% of your contribution to taxes now, so you ignore the fact that you might lose 40% of the total balance later. You have been validated by a corporate culture that uses the employer match as a carrot to keep you tethered to the treadmill. But understand this, a match is just a way to bribe you into a system where your capital is locked behind a cage of required minimum distributions and early withdrawal penalties. It is not your fault you feel squeezed. The system was designed to harvest your liquidity during your most productive years and keep it trapped until the government decides what the tax rates will be decades from now. They've convinced you to play a game where they can change the rules after you've already placed your bets. Let's look at the hidden math that your 401k provider's colorful pie charts conveniently omit. We're going to look at scenario A, the good soldier. We'll call him 401k Tobi. Tobi is 30 years old. He earns $90,000 a year and dutifully contributes 15% of his salary, $13,500, into his traditional 401k every year for 35 years. Tobi is told he is saving about $3,000 a year in taxes today. By age 65, assuming a 7% average annual return, Tobi's account shows a staggering balance of $2 million. Tobi thinks he's a multi-millionaire. He thinks he's free. But now, Tobi enters the withdrawal phase. In 2061, the national debt has ballooned, and the government has done the only thing it can do, raise income taxes. Tobi's millionaire status puts him in a high tax bracket. Between federal income tax, state tax, and the hidden tax of increased Medicare premiums triggered by his high income, Tobi's effective tax rate is 40%. When Tobi goes to take out his money to live, that $2 million instantly shrinks. $800,000 goes directly to the IRS. Tobi is left with $1.2 million. But it gets worse. Over those 35 years, inflation has eroded the purchasing power of the dollar. That $1.2 million in 2061 buys what $400,000 buys today. Tobi didn't build wealth. He managed a tax-deferred liability for the state while his purchasing power was liquidated. Now let's look at scenario B, the truth. This is Liquid Larry. Larry takes that same $13,500. He pays the taxes on it today, about $3,000, and takes the remaining $10,500. He puts it in a Roth IRA and a taxable brokerage account. Yes, he starts with less seed money, but Larry's money grows in a tax-free or capital gains environment. When Larry reaches 65, his account balance is smaller, let's say $1.5 million, but Larry owns 100% of that $1.5 million. He doesn't care if tax rates go to 70%. He doesn't have to ask the government to touch his money. He hasn't just built a balance, he's built a fortress that is immune to the tax bomb. Larry has $300,000 more in actual spendable wealth than Tobi, despite saving less on paper. Consider the real-world case of Tobi. Tobi is 55 years old. He has $1 million in his 401k. He decides he wants to retire early to spend time with his grandkids. He goes to withdraw his money. The system slaps him with a 10% early withdrawal penalty because he's under 59 and a half. Then the IRS takes 30% in taxes. Tobi's $1 million nest egg just became $600,000 overnight. Tobi is paper rich and choice poor. He has 7 figures on a screen, but he can't buy a loaf of bread without the government taking their cut first. Tobi is a victim of liquidity trapping. He realized too late that the 401k isn't a vault, it's a funnel. This is happening on a massive scale. According to current Federal Reserve data, the vast majority of American retirement wealth is held in traditional tax-deferred accounts. This creates a systemic tax cliff. The government knows this. They're sitting on trillions of dollars in future tax revenue that they can harvest simply by moving a decimal point in the tax code. They've encouraged you to defer taxes when rates are at historic lows, so they can collect them when rates are inevitably higher. You are participating in a forced partnership where you provide all the capital and take all the market risk, but the partner, the IRS, gets to decide their share of the profits at the very end. The reality check is this. The 401k is a tool for the employer to reduce turnover and a tool for the government to secure future revenue. It is not a tool for your freedom. To survive the tax bomb, you must adopt a tax diversity strategy. First, stop the blind max out. Only contribute to your 401k up to the employer match. That is the only part of the math that works in your favor. 100% instant return on your money. Beyond the match, every dollar you put into a traditional 401k is a dollar you are handing over to the IRS to manage. Second, prioritize the Roth. Whether it's a Roth 401k or a Roth IRA, pay the tax today. In 2026, we're in a low-tax environment relative to the massive debt obligations the country faces. Paying your taxes now is like buying tax insurance for your future self. Third, utilize tax-efficient brokerage accounts. Long-term capital gains rates are historically much lower than ordinary income tax rates. By building wealth in a standard brokerage account, you are choosing a tax rate that is currently capped at 20%, rather than an income tax rate that could hit 40 or 50%. Fourth, value liquidity over tax deferral. Having access to your money at age 45 without a penalty is a form of wealth that a 401k cannot provide. The ability to pivot, to invest in a business, or to buy a distressed asset during a market crash is worth much more than a $3,000 tax deduction today. The 401k is a scam because it exploits your desire for a safe path to make you a predictable source of future revenue. It turns your most valuable compounding years into a period of stewardship for the state. You are being sold the dream of $1 million retirement, so you don't notice you've been robbed of your agency. Your nest egg is not an asset if you don't know how much of it is actually yours. If you want to be truly free, you have to be willing to look irresponsible to HR. You have to be willing to pay taxes today so you can own your life tomorrow. Real wealth is the ability to control your capital without asking for permission. A 401k is a cage with a very long leash. But the 401k tax bomb is just the first layer of the control mechanism. The same people who told you to lock your money away for 40 years are the same people telling you that renting is throwing money away while they hike interest rates to levels that make your home a 30-year debt sentence. If you think the government owning 40% of your retirement is bad, wait till you see the math on the starter home trap that is currently wiping out the wealth of the under 40 demographic. Stop being a manager for the IRS. Start being the owner of your future. Because in a system built on deferred liabilities, the only way to win is to settle your debts before they grow.